Aloha and welcome to this webcast where we're going to guide you through the forgiveness component of the Paycheck Protection Loan Program. And this webcast is a third of an ongoing series, the COVID-19 Business Assistance Series, presented by Maui Economic Development Board, MEDB, and sponsored by the County of Maui. We greatly appreciate their support.
Okay.
Yes, Gerry?
Good. No, I was just watching the clock.
Okay, thank you. And so this is aimed at helping small businesses navigate the resources available to them to get through these challenging times. And we're targeting Maui. However, we do welcome small business owners, and we know we have lots coming from all over. Am I muted? Someone's saying I can hear just fine. Thank you for the comments. So just check the audio section of your system to make sure you've got the right sound system, because people are hearing us. And as you are there in the chat, do also let us know where you're from, because I know we do have lots from Maui and Hawaii, and we'd love to know where you are hailing from to join us here today. A little bit of housekeeping. My name is Annette Lynch with Maui Economic Development Board, and I'm here just to take you through some housekeeping. So this presentation is going to be about 30 minutes long, and then we've got Q&A. Might just have our presenters who are waiting on the backstage to mute their microphone for the time being, so we're just getting rid of some background noise there. So sorry. I'm getting distracted here. So on the right side, we've got chat, and great to see you chatting in there. We've got people from Kihei, Maui, Big Island, Honolulu. Thanks so much. And you've also got there the Q&A section. So please use the Q&A section when you're asking questions. So that's where we're going to be taking the questions from when we open up the presentation for those questions, rather than the chat. And then we also have a poll, so you can answer those polls at any time. I'm just going to start a poll right now to see where you're at with the Paycheck Protection Loan Program, whether you are approved, awaiting approval, or you are planning to apply. So tell us right now where you're at with that, and that will give our presenters a bit of an idea, the type of audience we have. Thank you. And at the end, we'll also be sharing a handout, making sure you've got a copy of the slides. So today's presentation will be led by Gerry Smith, Director of Business Development for MEDB, and beside him virtually will be Wong, Director of Hawaii Small Business Development Center, SBDC, the Maui Center, and Robert Kawahara, partner of Kawahara Hu, Maui's largest CPA firm. So hopefully you've read their bios in the registration page, so I won't go into that. Sorry about that feedback. I'm just going to close myself down. Right.
It looks like it's over to me.
There we go. Yes, it's over to you.
Okay. So aloha everyone, and welcome again to our third in the series. My name is Gerry Smith, Director of Business Development for the Maui Economic Development Board. And let me just set the stage on a couple of things about what we're trying to accomplish on this. We want you to be in the mindset now to be prepared to seek PPP loan forgiveness. But that's not going to be until 2 months from now. And so it's really important that you take steps now to be prepared to take action in 2 months, as opposed to waiting for 2 months and then realizing that you should have done something different. And so that's really the goal of what we're trying to do here today, is to just get you in the mindset of how to do this and maximize the forgiveness that's available to you. And I also want to tell you something else, that it's what we're working on right now is called the interim final rule, and interim final rule is not final. And so there's been a lot of changes. You know, this is unprecedented, and so the amount of information that's coming down and that needs to be digested is huge. And it's also subject to change. So we're giving you the best that we know right now. And if we don't know the answer to something, we're just going to say we don't know the answer to that. We're going to seek additional guidance. But for the purposes of this, what we're going to try to do is to bring you guys up to speed on what you can do now to protect yourself from a high loan balance later. And so let's go to the next slide. And I'm just going to throw this over to Wayne because there's been a lot of money that's been given out by the SBA. And Wayne, you want to tell us about it?
Sure. So this is just a quick snapshot of where we landed at the end of the first round when we ran out of PPP money. For those of you that have been watching the news, there is allocation to put money back into it again. And that's passed the Senate. Probably Thursday, it is going to be voted on by the House. And assuming that everybody agrees, President Trump could sign it into law as early as Friday. That said, SBA will probably need a couple days to get their portals working again, because as you can kind of imagine, there might be new timelines involved, and so on and so forth. So I would say, Monday is a pretty good shot at the PPP and the disaster loan portals reopening. So this is an audience, that are people who already have the money, and we're trying to tell them, give them some guidance on how to spend it to get forgiveness. But this is a snapshot of just what was given out in Hawaii compared to the nation. And then if we go to the next slide, that's probably easier for people to digest, which is in Hawaii. In the round one, 11,553 applications were approved. And that totaled $2.1 billion. And it's estimated that that should cover about 170,000 employees. So out of the 349 billion overall program, we got 2.1 billion. You're muted, Gerry.
Oh, whoops.
There you go.
Okay, so I'm actually looking at the poll here, and I find this really interesting that 72% of the people who are on this call have already been approved for PPP, and an additional 21% are still waiting for approval. So there's only 6% of the people that are on this call that are planning to apply. So my suggestion, I guess, for that 6% is do not delay and get your seat at the table and talk to the bank that your bank or the bank that you think you have the best chance of working with. So congratulations to 73% of you who have been awarded a PPP loan, and there are some time frames that you need to consider. Wayne, we're gonna go back to you to talk about this 8 weeks. Oh, and now you're on mute. This is a mute challenge machinery.
So there's some basic concepts around PPP in terms of there are things you can spend money on. Remembering again, the overall goal of the payroll protection is to provide salaries and wages for employees. Not so much a focus on the business itself, but really being able to provide payroll. And so there's also an 8-week period which you're watched in how you spend the money. So controlling what you spend it on, and then controlling what period you spend this on. And it may sound a little bit of a disconnect, because in a certain sense, people will ask, well, in 2 months, how much really has changed? And so the answer to that is really they don't know, but they had to put guidelines of some sort and stand by, because again, all these guidances are sort of open to interpretation and open to being changed. So now that we know more, but for now, if you're looking at forgiveness, the 8 weeks from the day you receive your money is extremely important to keep track of, because that's the time and that's the documentation that you need to use to apply.
Rob, do you want to add anything to that?
Thanks, Gerry. First, I just want to say hi. I see a lot of my clients are already here, which is a good sign. So maybe I'll get a little less phone calls after this. I'd like to kind of just preface or position this forgiveness as how to view it. And so people are getting confused as to what Wayne was saying. The PPP is a program, but the program involves a loan. So that's the first premise that you need to understand. This is a loan. If you comply, similar to a loan covenant, you will get the forgiveness. And that's kind of what we're focusing on here. And kind of the way I also want to look at this is, I kind of gave Gerry an example earlier, was when I order contacts online and they give me a rebate for those contacts, I paid full price for the contacts. But if I send in the rebate, it costs me less at the end of the day. If I choose not to, or if I didn't comply, I'm going to end up paying full price. So we're talking about one feature, but a lot of the terminology and the timing and the dates are being used. They get intertwined. And so some people, and a lot of the commentary and the questions that I've received have been presented in that this is a loan forgiveness, and then the difference is a loan. It's the other way around. You have a full loan for your PPP. What you qualify for, which we're going to discuss within the 8-week period, will qualify for loan forgiveness. And I'll add on to that later in the closing, but that's kind of what I wanted to add for the 8-week portion of this.
Okay. So that brings us to the question of what are you allowed to spend this on? What are allowable uses and what are allowable expenses? And Wayne, I'm going to go back to you for this one.
So in the next slide, we'll go into the exact specifics, but this concept is that, again, the PPP money is really to be used for specific purposes. And we're calling these the allowable expenses. The one thing that you need to understand, again, is, as Robert was saying, this all starts out as a loan, and that's the starting point. If you do these things, which is spend it in the right allowable expense, then you may be able to get a forgiveness for those portions. The other thing that, I like to make a point here is that it's interesting that in the guidance, what they consider allowable uses of this money, and what we mean by that is, what you agree to and what you certify to is, if you take this money, you will be spending it on these particular things and not to be spent on other things like, capital investments or some other things. So I'm not sure exactly how they're going to check compliance on that. But just understand that when you get this loan, you are certifying that you will stick within the guidelines of what is allowable. The other concept is that when we get into forgiveness, there is one point that is an allowable expense, but it's not forgivable, which is pre-debt, prior to February 15th. So it's allowable to pay some debt, pay off some debt, but it's not going to be a forgivable expense. So,
and how about that last bullet, the 24-month term 1%? Break that down a little bit.
So this is initially the initial deal. This is what you sign up for. When you are given the money, you are getting a 24-month term loan at 1%, and then additionally, they are deferring your first payment for 6 months. Interest does accrue for all of this. However, when if you get any of your forgiveness approved, the interest for those sections are waived. But as Robert was saying, day one, when you receive your money, you start your 8 weeks, and what you have is a 24-month term loan.
Okay, thanks. So I guess that gets us to, like, what are you allowed to use this for? So what expenses are allowable? Well, there's basically 5 of them. There's payroll costs, healthcare costs, mortgage interest, rent, and utilities. And you might ask yourself, why did I make payroll costs and healthcare so much larger in font than mortgage, interest, rent, and utilities? That's because the point of the whole PPP is to cover payroll. And so payroll and healthcare are weighted far more heavily in this loan than the other 3 that are down there. So if we can drill into what payroll costs and healthcare costs are, that's on the next slide. And what we'll find out is that payroll is a lot of things. It's not just the money that goes to a paycheck. There's salaries, there's wages, tips, that sort of thing, which is something that you would think of kind of like in a paycheck or that a payroll processing company would do. But there's a lot of other things in there as well. And one of them that counts as a payroll cost is employee benefits. And there's a bunch of different employee benefits. Robert, do you want to explain a little bit about why is that considered payroll?
Sure. I think the intent of the program is when you have an employee, you have other costs associated with that employee other than just the gross payroll, which is the first line item. Specifically, healthcare benefits in the state of Hawaii, as we're aware under the Prepaid Healthcare Act, most of us have to pay for the employee's portion of their healthcare. And so that, fortunately for us, we were able to add that as part of that since we can continue to pay that cost. State unemployment taxes is another one, and the various leaves, sick, vacation, parental, family, and other. You can still continue to pay those out as part of calculating what your payroll costs are. The guidance, kind of going back up to retirement contributions, my personal opinion right now is the law is somewhat ambiguous on this issue in that it leaves it open to interpretation. So without clear guidance, I would say my opinion without further guidance is that your safe harbor contributions that you are required to make are includable in that number in the retirement contribution. If you have a defined benefit, I would say that that is also a required or an allowable payroll cost. The question really comes down to the vast majority of small business owners have deferred or what we would consider employer discretionary contributions, and whether or not you can include those costs as part of your payroll. We're going to have to be on the lookout for more guidance on that. I'm a bit conservative on that issue right now, so my advice to date for most of my clients has been the deferred portion, which you have flexibility in making, is not part of that cost. Now that guidance may change, but it is definitely conservative in that regard. Again, when people applied for the PPP, that was left a lot was left to be desired on how people actually applied and came up with their numbers based on the guidance that was there. And so the impact to that is going to be when we are getting into the further loan forgiveness. Did you actually request too much money or did you request too little money? And how do you make certain adjustments with regards to the loan forgiveness? And again, the guidance by SBA hasn't been out there. My contacts with the banks have basically said, and we operated in that manner as well, is that we were handling this by the need. So the first thing was apply. The second part would be now what we're getting into is the loan forgiveness. And the third part is going to be how do we handle the loan? So we're kind of still not at this point, even anybody has even gotten close to running the 8 weeks. So while we're giving you a primer on this forgiveness, expect guidance to become clearer on what can be considered for loan forgiveness. And keep in mind that you still want to keep good records on everything. Gerry?
How is owner compensation part of payroll?
So interestingly enough, I mean, I think Wayne should chime in on this on the back end, like he did later. But I'll just kind of bring up what we did notice originally. So there were 2 opening periods to the PPP program. That was April 3rd and April 10th. And they put definitions in that kind of commingled among the 2 dates. But the way to look at it was April 3rd were for companies, employers with employees. April 10th was for self-employed individuals without employees. Okay. Now, as of April 10th, what the banks, and every bank was different, but for the most part, they held consistently in that if you applied on April 1st, they were asking for your 1099 that you received in 2019. And they divided that by 12, times it by 2.5, and limited you to 100,000 if that was the case. All right. Guidance came out on April 14th that basically said for self-employed individuals without employees, the way to calculate your gross payroll number is actually a substitute Schedule C or your actual 2019 Schedule C net income divided by 12 times 2.5, which is an entirely different number, which again leads into now what that I overly requested on my PPP number, and how is that going to impact my potential for loan forgiveness? Wayne, so the reason I mentioned you was you were talking about that little bit of a disparity in the language that still needs guidance to be cleaned up.
Right. So if you look at the proving document, right, which is Schedule C, line 31, which is net profits, for your application, it is divided by 12 in order to come up with a monthly average. But when you get into forgiveness and they look at how much, should be forgiven, the calculation is actually the net, that same line 31, but this time it's 8/52 of that line, which is, 8 weeks out of the 52-week year, right? So the problem is the math, when you do the math, the numbers are different, and the forgiveness 852 is actually smaller than dividing it by 12. Um, so there are some disparities between what you're allowed, what the application asks for, and what is forgiven. And right now we're trying to get some, is that intentional, or whether that's just sort of in the rush to get these guidances out, it was just sort of an authoring error. But just understand that, again, these are what guidance is out there now. The other reason why this was such a big deal was, in the traditional concept of what is a payroll was always, employees, and they took out anybody who was an independent contractor. That's no longer counted. But on the other side, they basically said self-employed people now can have a way to compute a payroll cost by utilizing their net profit, which takes into account your own withdrawals and everything else. So that's why it's a kind of an interesting thing that they allowed that, and we see that on the unemployment side as well, right? So the other part of CARES Act is talking about providing unemployment benefits, and they've extended it so that now it's not just the traditional eligible worker. Self-employed people now are also able to get unemployment. We have a few glitches in the state of Hawaii that we're not able to do that yet, but the Department of Labor and Industries has acknowledged that yes, they will be doing that. They understand that that's how the way it's set up. Just mechanically and infrastructurally, they're not set up to do it yet.
Thanks, Wayne. So it sounds
Sorry.
like, oh yeah, go ahead.
I just wanted to add one more thing that kind of falls into this here, and I think you're going to see a lot of people fall on both sides of this fence. Again, the guidance was unclear at the time, and it has since been cleared up in the interim final rule. But as of April 3rd, if you were a partnership, partners were allowed to be included as part of this. So you kind of hybrid blended your employee costs and then took your owner compensation as a self-employed, limited to 100,000 if it was above that for your partner. And the guidance basically said at the end of the day was partners are prevented from applying for the PPP on their own. It would have just made the program too cumbersome. So they anticipated that partners would be doing that, but they never gave the guidance as of April 3rd. So I do have just as many clients that have included it as clients who have not included themselves as partners. And so where does this true up happen? I'm hoping that we do receive guidance again for that. I know that is a question that is out there. If I had done something incorrectly or not, is there going to be a true up? And as of right now, unless the guidance comes out for that, we're kind of in this unknown certainty of how do you do true ups if you now have clearer guidance on what you're supposed to actually do.
And we'll certainly, as guidance evolves, we'll certainly keep everybody informed. So that this says payroll is a lot of things, but I guess payroll's a lot of not things as well. And so let's find out what the exceptions are to the rules. The first one I'm going to talk about here is you're limited to $100,000 per employee. So there's if somebody makes more than $100,000, then when you made your application, you would have reduced them to $100,000, and you are only eligible to use a salary of $100,000, nothing above. The employee has to reside in the United States. That's another one of the very clear rules. And then there's rules on double dipping. So who can clarify this? What this double dipping? What is double dipping? What's that mean?
So double dipping is not a true term. It's sort of a colloquialism that has come about to represent the concept that you're not to use various relief funds from different sources to pay the same bill again and again. And to the point of what we see most often, if you get a disaster recovery loan and you get the PPP, you're required to pay payroll costs with your PPP. Some people are saying, well, I've got more than I have in my PPP, so I'm going to pay the disaster loan. If that's the case, that's fine. But when you are paying the exact same obligation, basically representing to each relief, agency that you're making a payment on a certain obligation, that's what we've been calling double dipping. And most often you see that when you, if anybody's taken advantage of the CARES versions or the First Family Act of sick leave or family leave, right? These are relief funds that allowed you to allow your employees, even if you didn't have company sick leave, to provide them with paid sick leave. Then you can't, under your PPP, say, yeah, I paid that again utilizing PPP funds. So that's okay. The concept. It's really paying the same obligation with various sources of relief funds.
And I see here too, if you look at sick leave and family leave, the 7002 CARES Act tax credit and 7004 CARES Act tax credit come at a different time. That would that credit would come at a time when you filed your taxes. And so if you use the PPP and then filed your taxes and used the credit, then that's what the double dipping is. That's what those numbers mean there. And then this says no independent contractor payments. What's that mean?
So go ahead. Go ahead, Robert.
Go ahead, Wayne.
Oh, I was just going to say that this is really a lot of confusion because of the way things were talked about within the guidance. So in this particular case, when they're saying no independent contractor payments, what they're saying is that for employee count and for employee payroll costs, anybody that is a 1099 contractor to the business is not to be included in the payroll costs, right? The problem is that then other people, instead of talking about self-employment, unfortunately, quite often they use the same term. Independent contractors can apply on their own and so on and so forth. So they should have just said independent contractors are not eligible, period. But anybody that contracts to you are not going to be eligible for your employees. But they are self-employed people on their own and they can apply on their own. So that we get a lot of that question. There are a lot of small businesses that don't have W-2 employees or owners, which would have owner draws, but they do have a lot of their staff that are independent contractors, whether it's because they're seasonal or whether, there's various reasons why it makes sense to do that. None of those contractors to the business can be considered as employees or included in the payroll costs.
Rob, you want to add something to that?
No, I mean,
okay.
I think, on the initial push, when it was the Wild Wild West prior to April 3rd, we really didn't have clear guidance at the time. So some people did, some people didn't. We do now have clear guidance that it is clearly not to be considered part of the payroll cost. So I guess that really applies to 6% of the people who haven't applied yet. So, so we can kind of move on to that point.
Okay. So then So let's talk about, let's talk then next. What are we going to do here? We're going to say what other costs are there? So we just talked about a whole bunch of payroll costs, things that counted, things that didn't count towards payroll costs. But then there's three other categories: mortgage interest, not principal, interest, rent, and then utility. And so electricity, gasoline, phone, internet, those are the kind of other non-payroll expenses that you can use. There are some other ones there. I'm not going to go into much detail there because that's probably an individual case. And I'm going to give you some links at the end here that you can look up questions that are kind of complicated like that one. So these are the other things that you can spend money on, but these are non-payroll costs. So if we go to the next slide, let's just talk about how did we get here?
Jerry, can you back up the slide? Sorry, can you just go back for the benefit? I just did want to mention for those who are self-employed, a lot of you have home office expenses, and when you are figuring out your home office expenses, that really comes to a percentage of use of your total expenses. So some of these rent, utility payments that you are allocating, you will be able to consider that portion on that same percentage. So that's the guidance that has been issued for self-employed individuals that are using an allocated amount in their home office. They're still entitled to based on that same percentage that they're filing with.
Okay.
Thanks.
So let's go back to where we started from. And this is, you probably recognize this if you filled out your PPP application. This was the one number that was very difficult for you to calculate, which is the average monthly payroll. And the way you did that was you either used a Form 941 and used the money that you reported to the IRS, or however you did it, we used a payroll processing company and they gave you a report, whatever it is that your average monthly payroll. So you applied using, and I'm just going to use round figures here, that for $10,000, and there were 10 FTEs that you included in your account. There's some issues with FTE, and we'll probably touch on that a little bit later. But because your monthly average payroll was $10,000 and you multiplied it by 2.5, your loan was potentially for $25,000. And you probably remember checking those three boxes down below that said you were going to use it on some other things as well. So the mindset that you should be in right now is prove that what you said you were going to do is what you're going to do. And so the mindset you want to be in is that you're going to hire back all 10 of these employees for 8 weeks at full benefits. And if your $10,000 average monthly payroll figure was correct, you would expect to spend $20,000 in total on payroll and payroll related expenditures. And then the other $5,000 was what you could spend on non-payroll costs, payroll, lease, mortgage, interest, utilities, that kind of stuff. So let's go to the next slide. But what happens if you can't? What happens if you can't get all those employees to come back? Which, by the way, the guidance that I'm hearing is that if an employee has the opportunity to come back to work and is given the offer to come back to work, then he's no longer eligible for unemployment. So it's not really a choice between whether your employee wants to be on unemployment or wants to come back to work. Technically, if they refuse to come back to work, they're probably not eligible for unemployment insurance. So, but in a theoretical issue or a theoretical, what happens if you can't get all 10 of them back? What if you can only get 5 of them back? What if 5 have moved away, 5 have gotten other jobs, whatever it is that you can't get them all back? Well, you kind of need to rearrange your mindset to be in other words, you could have applied using the figures at the bottom there. And if you only got 5 of 10 back, then dividing that by 2, then your average monthly payroll would be only $5,000. But the big hit there is that in the case above, you had $5,000 with which to use payroll, lease, utilities, that kind of stuff. But in the reality of what happened, you're only at $12,500, or your loan should have been for $12,500. So what you need to expect is that you're probably only going to be forgiven for 50% of this. because you've only gotten 50% of the employees, and you're probably going to only achieve 50% of the monthly payroll. And anything that's left over is going to end up being a loan for 1% for 24 months with the first payment deferred for 6 months. So I'm trying to get you in the mindset of this is what you actually applied for at the top, and then the reality of what happens is at the bottom. If that happens, there are some consequences, and we're going to talk about those in a second. So there's some other things that we need to consider before we talk. We're going to do some calculations on this, but let's go to the next slide and talk about some other things that you really need to consider. The first is you can't just arbitrarily change salaries or reallocate money. So if let's say you had 10 employees and 5 of them for whatever reason could not come back, then you can't just give everyone the remaining 5 double salaries and call it a day. That's not going to work. So you can't arbitrarily change salaries. Of course, you're limited to $100,000, but you can't give raises to fewer full-time employees to make up for the difference. Basically, what you're going to do is you're mirroring what you said you were going to do when you applied. And the other thing, you can't reduce individual salaries significantly. You know, you're taking a snapshot of time before COVID and a snapshot of time after, and the two should try to match up as closely as possible, because your loan was premised on your payroll being accurate. And so there's just a couple of things you need to consider there. Rob, I'm going to let you cover the next couple there.
Thanks, Gerry. So I guess I get the one that, just in the last, I would say 3 days has been quite controversial that I'm learning. So a lot of my clients, they're on the web, they're researching, they're talking to other professionals, and they're attending other webinars. And I got wind that, the advice that we're giving with regards to the 8-week clock starts when you get your funding. That is supported, in our opinion, by the interim final rule, as well as the frequently asked questions posted on the Department of Treasury's website. I do want to state, though, that the law as it is written under the Section 1105 of the loan forgiveness portion, they do originally use a covered period that is June 30th, 2020. But that June 30th, 2020 for loan forgiveness no longer shows up in any of the guidance thereafter. So it is written in the law, but all of the guidance issued by the Treasury in the interpretation has said that it is now an 8-week clock that starts when you get the funding. So the June 30th deadline does have some applicability. The first is that the PPP program is technically set to end on June 30th, 2020. The second time the June 30th is also mentioned is that employers must return to their pre-February 15th employment levels by June 30th. So when we talk about this covered period, specifically when you look in the law, is only relating to the original loan forgiveness timeframe. But now we are saying that is the 8-week clock that starts when you get your funding, is used to determine the period in which you are going to allocate your costs or accumulate your costs for the loan forgiveness portion. I'll kind of just move along to that. How have you modified your procedures? Is it going to be that we're going to need to do updated chart of accounts? If it helps you to track your PPP money, it's something that I wouldn't advise against. Anything that helps you to be more accurate is definitely going to ease you on your loan forgiveness portion. The least amount of commingling or explanations that you need to do is going to make it easier for you on the loan forgiveness portion. Following that same line of thought is, originally, I saw people saying you should open up a separate bank account, and segregate those funds. And, I'm an accountant by trade, and I'm saying accountants, we track money. That's what we do. We show you where the money went. If at the end of the day, that's where it went, you should be fine. In the interim final rules, though, there is this little section that says, what if I misuse my funds? And it basically is stating that you need to use your funds on allowable costs, whether it's during the 8-week period or the life of the loan. And currently, that is determined to be 75% of the total PPP that you receive should be in payroll, 25% will be in your other non-payroll costs. That's for the life of the loan. You can throw the forgiveness portion out. You need to spend that money. Now, the question is, do I need to spend it dollar for dollar out of that PPP bucket, or can I just account for it? And I'm almost leading to the opinion now, and to make it easier for people, is if you had that money in a separate bank account and that's where you paid your payroll, that's where you paid some of these other non-payroll costs, it makes it that much easier for you to put that package together on the back end when you do apply for loan forgiveness at the end of your 8-week period. So, Gerry, did you want to add anything to that? But that's kind of what I wanted to mention on those three.
You know, that's great, especially if the bank that your loan is the same bank where you do your banking. That might make it really easy. Wayne, I'm going to let you take the next two on this list.
Yeah, so the first one is a little bit in turmoil, because this almost exact text shows up in several places, but most importantly, people that have gotten their PPP loans have this wording in their term sheet. So they definitely have agreed to this. So it's basically saying that forgiveness amounts, you know, whatever you end up with in terms of being forgiven, will be reduced by any economic impact or economic injury disaster loan advance amounts. We've gone back to the SBA several times now to try to get clarity on this, and just in a conversation with the SBA right before this call, the SBA person said that their intent there was to avoid double dipping. And so what they're saying is that if part of your disaster loan was targeted for payroll and you're getting PPP money and you're going to pay it, because there's no double dipping, the advanced portions need to be reduced in terms of what forgiveness there is. In the call we just had, they basically said that there should be guidance that will come out that will say that this is an attempt to just address double dipping. So if you can show that you're not using the advance money or the disaster loan money for the same thing that you're going to pay with your PPP money, then there is no reduction of your forgiveness amount. So that's a verbal, and so until we see it in writing, but at least we've got somebody thinking about this, and they will address it. The next point is really to have a clear understanding of what you signed up for. So when even though the funds were authorized by the Treasury, and you know the SBA was given the authority to go out there and implement this, the deal that you have in terms of your loan is between you, well, essentially your company, and the lender. Everything that happens is really between you and the lender. So when it comes time for forgiveness, you will apply to your lender, and it's the lender that will vet your documentation, and if per their understanding of what the rules are, they will grant or not grant forgiveness. And it's going to be very difficult to try to look for an appeal process, and there may even be, the SBA even agrees that because they are giving a lot of latitude to lenders, that there may even be some slight inconsistencies with the way different lenders decide on the forgiveness. So that's something you really need to understand, that even though this program is an SBA funded program or Treasury funded or CARES funded, the deal that you have is really between you and your lender. And so all your negotiations, all your working and everything else needs to be done with your lender.
Okay, that's good advice. So then I'll take this last one. I'll take this last question, and I'm going to address it to everybody who's listening here. And my question is: do you have a plan to track your expenditures? I mean, what are you going to do? Do you have some kind of plan on how you're going to do this thing? And I've been thinking about this for a little while, and so I thought about how I might do it. And so if we can go to the next slide, I'm just going to give you an example of what I'll call a perfect loan. And in terms of perfect loan, it ends up being a zero loan. So let me just here's some listing of different expenditures that I made, and you'll notice that I've classified them into categories of acceptable costs: payroll, rent, utilities. There's some healthcare in there, that kind of stuff. Utilities. So I'm jotting these down, but I'm not rolling them up yet, because I'm just kind of listing them here. But then I want to roll them up, and I want to go, well, what if I added all the payrolls together, and what if I added all the rents together, and what if I added all the utilities together? It would probably look something like this. And so let's just talk about this one. This is some big game lure fishing company, and their payroll PPP loan amount was $26,000. And you see down below, about 1, 2, 3, 4, 5 lines down below, it says the non-payroll percentage. And if you look at the chart off to the left there, you see that the non-payroll percentage in this case is 25%. It's hit it exactly. And so if you look down below where it says allowable payroll costs, back in that yellow table that we were looking at, there was $16,000 worth of payroll if you added them all up, $4,000 worth of healthcare, for a total of $20,000. And so this person has spent, the PTD means project to date, so the PPP award amount was $26.6 thousand, and then the total spent was the exact same amount, project to date. The non-payroll percentage was exactly 25%, and it appears at the end of the day this would be a fully forgivable loan. You would have zero loan at the end of that. But this is voodoo. It's never going to happen perfectly like this. So let's go to the next one, and I'm going to look at an example of something that doesn't exactly work right. And so in this case, this person had a PPP award amount of $65,000, but was only able to spend $41,000 project to date. And so what this does is it decreases the amount of allowable payroll costs. And you can see here in the blue circle that the total payroll costs are $30,000. And so using my algebra, I can figure out that 75%, if the subtotal of $30,000 is 75%, then the entire costs are $40,000, and the remaining $10,000 is eligible to be spent on non-payroll items. And so, looking at this really simply, these are why I chose the numbers. If you look at the non-payroll is $10,000 and the payroll is $30,000, it's pretty clear that the payroll is 75% and the non-payroll is 25%. So you cannot spend the entire $11,400 because you're only eligible to spend $10,000. So let's go to the next one. And so what I have to do is, you see, I've spent $11,466 on non-payroll costs, but I'm only allowed to spend $10,000. And the $10,000 is based on the fact that I spent $30,000 on payroll. So I'm only allowed to spend $10,000 of that $11,466, which means that $1,466 of those non-payroll costs are not going to be forgiven. And so the bottom line of this is that only $40,000 of this is going to be forgiven. If we go to the next slide, the loan that you end up with here is going to be $25,000. Because what I'm doing here is I'm taking the 14. I've got the funded amount of $65,000, and I've spent $41,466 so far. $1,466 of those non-payroll costs are going to be unforgiven, which means that the project to date less the unforgiven is $40,000. My loan's for $65,000. I'm going to end up with a balance at the end of $25,000. Now, the one thing I want to point out to you doing this calculation is there should be $23,000 somewhere in this bank account, because they didn't spend the full amount. So, you know, I don't want people getting upset about the fact that at the end of this thing, I'm going to have a loan for the unspent amount, when in fact you're going to have that same unspent amount likely in the bank. Anybody want to add anything to that before we take a few questions? We're really running long here, so I want to get to those questions. So shall we delve into a few of those and see what?
Sure.
So I'm going to go to the Q&A, and I want to stick to ones that are PPP related. I'm gonna stay away from that first one, stay away from the second one, because I don't want to go with any lenders that you know we have.
Well, actually,
I didn't start
let
this
me
topic.
let me jump in on number 2 from guest 540, and there were 7 upvotes on that. I was going to kind of do that in my conclusion anyway. So please, the question is, please confirm that the forgiven loan amount will not be treated as taxable income by IRS. What about the state? All right, so in the law, it is specifically stated that this PPP, any amounts forgiven, will be treated as cancellation of debt income. Now, normally that is treated as taxable income at the federal level. However, they follow along with additional guidance in the law, not guidance, it's actually stated in the law that the IRS will not be treating this particular cancellation of debt income as taxable. So, to answer your question, it appears that the loan, the forgiven amount, will not be taxable income. And this is the part that I can't clarify or provide you 100% guidance on. It appears you still get to keep those expenses. Okay? So at the federal level, let's jump to Hawaii, and I'm only going to answer for Hawaii here as for the state. So the state of Hawaii conforms to the IRS. We are considered what is considered a static conformity state, meaning we comply on an annual basis with the provisions of the IRC code. We don't have a rolling conformity like other states. So our state may or may not conform to the tax treatment where the cancellation of debt income is not taxable. So you could run into a situation where for federal purposes, it is not taxable, but for Hawaii, it would be considered taxable. And so you would have taxes due on any amount of loan forgiveness for Hawaii. Commentary, opinion, given state of Hawaii's position in budgetary crisis, I highly doubt that they're going to conform, but my fingers are crossed. I mean, if you can write to your representatives now is the time to let them know that, you know, this might be an unintended burden that will not show its head until April 21st or April 20th of 2021. So just keep that in mind.
Okay. I'm going to look at the next one. There's from Mike. Do you need to pay employees from the start of the 8-week period at full complement equal to what you had before? Or is it work up to the full complement of staff and use 75% of the funds prior to exit of the 8 weeks? I guess the way I'm going to take a stab at that. I'm going to say the way I'm going to answer that is you may not get all you may not get all of your employees back on day one. But I think that the answer that I'm going to give you on this is what you're trying to do is you're trying to mirror what happened, what your payroll was before any of this stuff happened. And so you're trying to get back to that. Now, if you can't get fully back to it, it probably means that your loan was overstated to begin with. And so then the question is, you know, what are you going to do if you're trying to ramp up? Then you're not going to hit the full 8 weeks in a single period. You guys want to chip in on that?
Yeah, so here's the deal. So as part of the June 30th deadline that I mentioned with regards to bringing your employment back up to full employment level, there is a period of time from, I believe it is February 15th through April 26th, which is what, 4 days from now. where that employment level is not going to be counted against you for the portions of the loan forgiveness. Again, what we're talking here is about what will qualify for loan forgiveness. And so what they're saying here is that you have until June 30th to return yourself to pre-February 15th levels. Again, that can be subject to interpretation as well. But the way the law reads is you have until June 30th to return to your pre-February 15th employment levels for the purposes in calculating your loan forgiveness.
Okay. There's a question here that talks about retroactivity. Does anyone want to take a stab at that, or I kind of feel like maybe the answer on questions as detailed as that might be that we're waiting until further guidance comes out. I'm responding to the question from Jack. Do you guys want to take that?
Wait, unless you know something that I don't, as far as I'm aware, the terminology that they're using today and the guidance provided today is your period of loan forgiveness only starts on the day you get funded, and that's the 8-week period. So absent any conversations to retroactivity, I don't think there is a provision to go back to the covered period beginning in February 15th, even though you got funded tomorrow. So my personal opinion and what I would be telling my clients is that really you're keeping your calculations going forward from the date of funding. I don't know if you concur with that or not.
I concur with that. I mean, the February 15th date, the most use of that date is not about retroactivity, but to say that one of the qualifying things to be able to be eligible for the loan was that you had to be in operation on February 15th. And then in the forgiveness statutes, it basically says it's for payroll costs that are incurred and paid for in the 8-week period.
I see James' question here, and I think we'll take a stab at that one. Again, that one has 10 votes.
So let me try and tackle this one at the beginning of this, if you don't mind, Wayne.
Sure.
So this is that one, Gerry. I think you attended that same webinar the other day, and we kind of talked to this offline. And my clients have also responded to this. So our advice is in direct conflict to another webinar at this current time and current information that they believe that once June 30th is over, any unused funds must be returned to the SBA. I've done a huge write-up on this back to one of my clients. So Jim, on this one, I'll forward you that email later, but let me put this out there to everybody. If I can work with MEDB on this Q&As, and if I can capture these Q&As, I think I gave Gerry my information for you to subscribe to my newsletter. And what I would like to do is try to answer as much of these Q&As for you inside of my upcoming newsletter, where I can really delve into specifically what Jim's question is. But my understanding is forget the loan forgiveness period, first of all. Forget the 8 weeks. You have a loan. You got applied for a loan. It is due in 2 years. At the very minimum, you must spend 75% of that total loan in payroll costs, and only 25% can be spent on non-payroll costs. Now, the portion that is spent within the 8-week period from date of funding would qualify for loan forgiveness. But there is nothing that prevents you from using the funds beyond June 30th as far as the guidance. And again, I will do in my next upcoming newsletter, I do know that I have to address it. It's all respect to the people that are doing this other webinar. But where they tripped up, in my opinion, is they are attorneys and they looked at the CARES Act law, specifically Section 1105, which is the loan forgiveness portion, which states a covered period from February 15th, 2020 through June 30th, 2020. And this is where I'm mentioning that the interim final guidance, and it's also in the Federal Register now, also on the Department of Treasury's website. This, in my opinion, supersedes, and you are allowed to rely on the guidance issued by the Department of Treasury and the Federal Register, which is using the 8-week period of spend. Let me just give a practical example, and I'll kind of close with that. we all know the program ends on June 30th. Okay, so you have until June 30th to apply for the loan. So let's just say you take it up and you apply on June 20th. You don't get funded till June 30th. You get your money on July 11th. By the attorney's definition that I've seen in this conversation, you'd have to return the money. I mean, you basically got nothing because you'd have to return it because you're past the June 30th period. So there was, in direct conflict to the way the program runs, to interpreting a different covered period within the loan forgiveness of this loan program is where the advice is being misinterpreted, in my opinion. And again, I'd like to think that, I've checked with enough people. I've also checked with the bank, and the bank is under the same understanding that they don't believe that you can't spend any of this PPP money after June 30th. Okay. So that's kind of my input on that. Again, I'll do it in my newsletter with the detail and the support for that. But I am aware specifically that there is advice currently that as of June 30th, any money spent on the PPP afterwards is likely illegal and needs to be returned to the SBA. That's the other advice that is out there. The impact to that is in some of these other chats where they've echoed the commentary that is out there. We're closed for business, America, right? Hawaii, we're closed. We're not open. There's the only point if I fully spent all of my money today would be to benefit my employees and they would go back on unemployment and I'd maximize my 25% of the PPP, non-payroll cost. Sure, but then I don't have any money. I've talked to some of my larger clients. They're not expecting anything until really fourth quarter of this year and going as far as to the second quarter of 2021, which means from our business perspective, we are looking at hoarding cash and making that cash last as long as possible. And the loan forgiveness portion becomes a smaller and smaller conversation in us trying to survive through this pandemic.
I'm gonna stop it there. I'm gonna go to the next slide, and I wanna just thank you guys. I want to be very respectful of everyone's time who's on this call. I realize we're going over a couple minutes here, so let me just wrap up some things really quick for you. Let's go back to, there's some links that I want to show you here. There's a link. The first one is to the MEDB, the MEDB website. And that's mauibusinesses.com, and that'll have the videos that we've produced here and the PowerPoints that come with them, along with the questions and answers. Please go there and get a copy of this PowerPoint slide for your own use. I'm including the link to Brain Gain Hawaii. I think we've talked about that group a couple of times on this. First off, I really respect what they've done. They've done a fantastic job. And there's some really interesting resources that they've put on their site. So I left that little link there for you. And I strongly recommend if you want to look at it from the legal perspective, they have a really good memo there. It's that PDF file. The name's a little bit long, but it's on their website, and I suggest you take a look at that. And then just another website that has helpful tips, and that's from the County of Maui, and that has it's the COVID-19 MauiNui.com website, and has all kinds of links and resources and that kind of thing. I want to make sure that I thank the County of Maui for their support for this type of webinar. Again, we're trying to reach as many people as we can in Maui County and do the best that we can to fight for our local businesses. I wish you the best in this tough time. And if you have questions or need assistance, you have anything that you need to do, send me an email or give me a call. There's my number's there, and Wayne's is underneath. I wish, Wayne, that I'd put yours much larger than mine in first, but I didn't. So there I am. Right. And I really appreciate your time, everyone, and good luck. Annette, do you have any closing words for us? Thank you again for your time, and thank you, a big hand, virtual hand, to Robert and Wayne for their assistance in this effort. Thank you.
Yeah, thank you, Gerry. I just wanted to add that we will be posting all the, we'll be answering the questions, as particularly the most pertinent ones that keep popping up. and posting that to our webpage, and we'll be sending out links to that and the replay and the slide deck. I'm just going to share the slide deck now. That'll be pushed out and pop up on your screen. You can download that here now, or can wait for the link. So sorry about the feedback that's coming on. That sounds like it's me. So we'll end it there, and thank you so much for your participation.